Well, good afternoon and a very warm welcome to Stewardship's dial-in webinar. My name is Jackie Fletcher and I oversee our Treasurer Services here at Stewardship. I'll be your host on today's call, and I'm delighted to be joined by our resident experts, Alan Howe and Stephen Matthews, who are both senior consultants here at Stewardship. Now, I know that many of you will have joined us before, but if you're new to Stewardship, then I would just explain that our vision is for the world to encounter Jesus through the generosity of his church. And one of the ways that we seek to achieve this is by strengthening Christian causes. And the purpose of this dial-in is to equip and encourage you in the important role that you have within your church or charity, and thus enabling your organisation to confidently live out your mission. If you'd like to find out more about how we can help support your church or charity, then do take a look at our website or call John Keskes, our Head of Partnerships. His details are on your screen now. If you've joined us by phone, the slides will be sent out after the call. If you'd like to make sure that you receive the follow-up materials, including the podcast recording, you'll need to make sure that you're signed up to the Treasurer Dial-in mailing list. And if you haven't yet done so, you can find the sign-up form at www.stewardship.org.uk/dial-in and just scroll down to the bottom of the page. So let's look at today's agenda. Who would have thought just a few short months ago that COVID-19 would so come to dominate our lives? The physical doors to our churches are closed, as are many of the other organisations that we work in, and the freedoms that we've become so accustomed to have been severely curtailed. But amid all that change, it's comforting to know that certain things remain constant. Through it all, God remains steadfast, and the wheels of charity finance continue to turn. There are still bills to pay, finances to manage, and annual accounts to complete. So we want to devote this dial-in to a number of COVID-19 related finance issues. These are not new issues, but issues that have been brought into sharper focus as we grapple with the impact that seeking to stop the spread of COVID-19 is having on our daily lives. So before taking questions later, we are going to cover the following topics. We're going to look at managing your finances and the role of reserves, followed by the annual report and accounts. I'm going to take a brief look at some employment matters, including the updates to the furlough scheme. Then we're going to look at other available financial assistance, making decisions as trustees. And then this final one under COVID-19 is what we have done. And this is where Stephen and Alan will share their practical approaches to steering their churches through COVID-19. Each of these topics is supported by written materials that are available on our website, and we would encourage you to visit this section of the site regularly as content and links to other sites are frequently updated. You can find all of this information at www.stewardship.org.uk/COVID-19. And today we're also going to squeeze in one mosquito effect, and those are the small annoying things that can come back to bite us. And the one that we're doing today is gift aid common errors. And finally, we'll have our Q&A section to finish off the call. Thank you to those of you who have sent in your questions by email already. It's really helpful for us to know the issues that you're grappling with, and we will cover these later in the call. Now, we do encourage participation. This call is for you, so if you have any questions, please do use the chat function to ask them, and we'll answer as many as we can during the call. If you click on the chat icon, type in your question, and make sure it's addressed to all panelists. Then those who have joined us on your phone, you're not going to be able to ask us a question on the call, but hopefully the resources that we send out afterwards will address any issues that you have, and you will, of course, be able to hear answers to questions that are typed in during the call. So without further ado, let's begin with the first item on the agenda, which is managing finances and the role of reserves. And this is going to be brought to us by Alan.
Brilliant, thanks Jackie. So how do we manage our organisation's finances? Well, in seeking to explain the end times, the book of Revelation tells us of the forces of the beast that stand against Jesus. But in chapter 7 and verse 14, we're comforted to read, "They will wage war against the Lamb, but the Lamb will triumph over them because he is Lord of Lords and King of Kings." So as Christians, we know that Jesus is King. But when it comes to managing finances in turbulent times, it's good to remember the old financial saying that cash is king. A lack of cash, and that is money held in readily accessible bank accounts, is generally the cause of most organisations' financial difficulties. So when it comes to cash, there are two questions to ask. What can you get your hands on now? And what is likely to happen to cash over the coming months, a cash flow projection, if you like. So let's take them in order. What can you get your hands on right now? Well, money held in unrestricted funds is generally available to use in accordance with the charity's charitable purposes. So that's fine. Money held in designated funds remains unrestricted, but has been earmarked by the trustees for a particular future purpose. Now, the trustees have the power to remove that designation, so making that money available for general use too. However, money held in restricted funds can only be used in accordance with the purpose that meets the restrictions, and so money held in those funds is not available for general use. You might be able to borrow money from restricted funds, but that is neither guaranteed nor straightforward. So cash held in unrestricted funds, perhaps with its designation removed, is what is generally available. But be wary of out-of-date bank mandates, particularly for accounts that have been tucked away, perhaps for years, perhaps in a different bank. Who is on the mandate? Are they still around? Can they be easily reached? Now is a very good time to amend those mandates and bring them up to date. And do not be scared to dip into reserves. I'm reminding of Pharaoh's dream and the interpretation that Joseph provides in Genesis 41:28. It says, God has shown Pharaoh what he is about to do. 7 years of great abundance are coming throughout the land of Egypt, but 7 years of famine will follow them. Now reserves are established in those times of abundance for those times of famine, times just like these. The Charity Commission is clear when it says reserves can be spent to help cope with unexpected events like those unfolding at present. Now, how far your reserves will fall will depend upon two things. The decisions you make about when and how deeply to cut non-essential expenditure, and external forces over which you have very little control. Once the world emerges on the other side of COVID-19, it may then be the time to replenish reserves, ready to meet the next challenge. And we've updated our briefing paper, How to Think About Reserves in the Light of COVID-19, which explores both the biblical and the practical considerations when considering reserves. So let's move on to the cash flow projection. What is likely to happen to your income now, whilst those restrictions are in place, and later when we face a very new and different financial landscape? So on the income side, how will your donations hold up? Are you heavily reliant on offerings taken up at church services? What's the underlying financial situation of your supporters? Are they secure? Are they furloughed? Have many been made redundant? Perhaps it's even time for a general appeal. And then what about income received from renting church buildings or from other charitable activities, maybe conferences or other ministry activities, all of which may come under pressure. When it comes to expenditure, leadership teams will have to decide what expenditure is essential, what would be nice to keep going, and what can be stopped immediately, remembering that for some expenditure, there's still going to be a lead time. It is also a time to be cautious about entering into long-term financial commitments, for example, leases, as part of protecting cash at times of uncertainty. Take time to explore the financial help that is out there, and perhaps apply for a mortgage holiday or speak with your leaseholder. Look at the government-backed loan schemes. There'll be more on those a bit later on. And if a church, see whether there is help available at a denominational level. Now remember, if you've not already furloughed staff, this option is no longer available. And again, more of that will come later in this webinar. So now you're armed with the information, you can construct your cash flow. Do not make it too complicated and be realistic. Categorize income and expenditure in just a few simple lines and be prepared to keep returning to and adapting the projection as reality replaces estimation. Setting cash trigger points when pre-agreed actions will be implemented. Those pre-agreed actions form your plans B and C. These plans should set out what you will do in the event that your cash level drops to those predetermined trigger points. Activating an already considered, agreed and prayed through plan will be far less stressful and problematic than trying to devise one on the hoof. And when setting trigger points, be careful to leave sufficient time for planned actions to take effect. Now, our resource COVID-19 Financial Planning and Reserves for Churches and Charities fleshes out this process in more detail, concluding as follows. Firstly, pray and do not panic. Then, understand your current situation, construct a cash flow projection, plan for all eventualities, even those you dislike, communicate openly and often, be prepared to adapt, and keep praying. The outworking of COVID-19 is inflicting serious financial damage on economies across the world. We need to prepare for what will emerge on the other side, called to being people of faith and not just people of finance.
Thank you, Alan. Now, Alan referred to our briefing papers, and just a reminder that they can be found on our website at www.stewardship.org.uk/briefing papers. Now, let's move on to our second item, the annual report and accounts, and this is with Stephen.
Jackie, thank you very much. Now, what does COVID have to do with producing accounts? Well, the accounts and the trustees report are to give readers an explanation of what has happened and what is the charity's financial position. This is partly about what's legally required, but also about what people want to know. The legally required bit depends upon whether you're preparing receipts and payments accounts or accruals accounts under SORP, SORP standing for the Statement of Recommended Accounting Practice for Charities when you have to prepare accruals accounts. The areas we think you need to understand today are for accruals accounts under SORP, the trustees' annual report, what goes in there, about post-balance sheet events, and going concern and what that means. For receipts and payments accounts, it's about the trustees' annual report and the impact on the statement of assets and liabilities. Now, what the readers want to know bit is because COVID is having a massive impact on all areas of society. So readers of the accounts will want to know what you're doing about it and how you're going to weather it. So let's start by looking at the trustees' annual report, then post-balance sheet events, and finally the issue of going concern. Now, with the trustees' annual report, the TAR, the SORP committee has suggested a number of specific areas trustees should include in their reports. SORP committee are important when you're preparing SORP accruals accounts, and if you're preparing receipts and payments accounts, we suggest, but it isn't mandatory, that you also cover them. The three key areas are these: how COVID has affected your activities, closure of church or other meetings, and the extent to which activities have continued online, the impact that social distancing might have on community activities like food banks, etc., that sort of thing. The second is the impact on staff, volunteers and beneficiaries, e.g. are you furloughing, are there layoffs or new ways of working? And thirdly, the impact on the finances and the reserves policy. If you're hardly affected at all financially, and some aren't, then say so. If seriously impacted, then the trustees should explain the situation and the plan and what will happen on reserves, or what they at least expect to happen on reserves. The second area is about post-balance sheet events, or PBSE. These come in two forms: adjusting events, which change the numbers in the accounts, and non-adjusting, which don't change the numbers in the accounts but do need disclosure in the accounts. The key to which these are is in the timing of the conditions causing the event. Examples of adjusting events include the cancellation of a conference or other event that was due to take place in the new financial year, but was cancelled due to the outbreak of COVID-19 before the year end. The expenditure on planning, booking and other advance payments will no longer be prepayments, but be a sunk cost expensed in the year. Secondly, a provision may be required for other unavoidable fees that will have to be paid after the balance sheet date. So that affects your balance sheet. The non-recovery of a debt due to the debtor's financial circumstances at the year end is another example. Although it only becomes, in that sort of situation, the circumstances changed by the year end, even if it's only known to you after the year end. In both cases, the conditions causing the event existed at the year end date. Examples of non-adjusting events would cover things like a significant change to reporting charities' activities or level of income and expenditure that have occurred since the year end. E.g., you're a March 2020 year end and you've had a serious loss of income due to lockdown from April onwards. Or, coming back to your debt example, the non-recovery of a debt due to the debtor's financial circumstances deteriorating since the year end. They could have paid you back in full in March, but they've gone downhill since then, and now they can't. Those are non-adjusting events. As COVID-19 emerged in the UK during early 2020, for organisations with a year ended to 31st of December 2019, it's not likely you'll see adjusting events due to the virus. And if the accounts are being completed now in early June, even the disclosure of non-adjusting events are likely to be quite high level. But will get progressively more detailed if the accounts are being approved late in 2020, as you know much more about what's actually hit you. For non-adjusting events, trustees should aim to disclose the impact of COVID-19 and, where possible, estimate the financial impact. But you can use a discretion as to decide what level of disclosure is helpful to those reading the accounts. We have a resource, COVID-19 and the annual accounts, on our website, and this explores the area of post-balance sheet events in more detail and provides a number of examples. The third area is going concern. Going concern is one of those accounting technicality issues. It is the assumption that the organisation will still be operating 12 months after the signing of the accounts. Now, for some organisations, this might be a real issue. Where there is a significant going concern uncertainty, in other words, you may not be operating in 12 months' time after signing the accounts, this should be explained in the trustees' annual report together with measures you're taking to address these uncertainties. For example, a church that's lost a lot of rental income and is reliant upon it, but it's taking up special offerings which the trustees believe will cover the cash needed to operate over the following 12 months, and also maybe negotiating additional credit with its bank. You explain those sorts of things. Now, it's only in the most extreme cases where the trustees do not consider the charity will be able to continue that accounts should be drawn up on a different basis. Now, I've only ever seen this 3 or 4 times in my entire 40-year career as a chartered accountant, so it certainly is rare. Now, none of us can be confident about what's going to happen, but it is worth remembering that churches in particular are resilient places. Income can be boosted by special offerings and gifts, and expenditure may be more flexible than in other organisations. Also remember that going concern disclosures in the accounts are not about whether your church will continue to operate in the same way as it did before the virus struck. Going concern will only become a big issue if a church or charity's financial situation deteriorates or is expected to deteriorate to such an extent that there is a significant and real risk that the organisation or major part of its work will not be able to continue. So, document your plans because your examiner will need to see them, but hopefully there won't be too much problem. We have a briefing paper on our website called A Church-Eyed View of Going Concern that explores this whole area in more detail. I hope that's helpful. Thanks. Over to you.
Thank you, Stephen. That's really helpful. So don't forget to be typing in your questions as we go through the call. We're going to move on to our next item, which is employment matters. And I'm going to be bringing you that, including the latest on the job retention scheme. So in the last dial-in back in February, a lifetime ago now, we talked about how to look after your workers and promised that we would continue this time with a look at the more formal aspects of employment, such as employment contracts and national minimum wage. Well, a lot has changed since then. So instead today, we're going to look very briefly at employment contracts, but I'd also like to highlight some of the common pitfalls with claiming under the new coronavirus job retention scheme. And I'm also going to outline some of the main changes to the scheme in July. So firstly, employment contracts. On the 6th of April this year, new regulations came into force. The main changes are that the right to a written statement of employment is now a day one right, and this now extends to all paid workers as well as your employees. There are additional requirements for the information that should be included, so you will need to check that your employment contracts going forwards comply with this latest legislation. Now, although you don't need to reissue written statements to your employees unless they request it, this is probably a good time to review your templates and update them if necessary. If you're not sure where to start, we do have updated employment contract packs, which are specially designed for Christian churches and charities, available to purchase through the Stewardship online shop. Now, the last time we were here, the term furlough was barely used in everyday conversation, but it's now become the buzzword on everyone's lips. Introduced on the 20th of March, the Coronavirus Job Retention Scheme was introduced to enable people to remain in employment during the COVID-19 pandemic. Employers can currently claim a grant of 80% of salary or $2,500 per month, whichever is lower, along with the associated employer NI and pension costs. Hopefully, if you're using the scheme, you've managed to keep up with the evolving requirements. The first claims were made on the 20th of April, and having done in excess of 280 of these for our payroll clients, the system does seem to be pretty efficient, with payouts generally being received within 6 days. I would advise you to bookmark the guidance on the gov.uk website, as this is updated on a pretty regular basis, so you need to check that you're still meeting all of the requirements of the scheme. So firstly, I'd like to look at some claims and highlight a couple of the pitfalls that we've identified as we support clients who are using this scheme. The first is the hard deadline of the 19th of March, which affects whether your newer employees are eligible for the scheme. We know of several employees who, although they started work well before the 19th of March, were not eligible because their pay had not been reported to HMRC through an RTI submission before midnight on the 19th of March. This has particularly hit monthly payrolls, where the submission would not be due until payday, which is usually at the end of the month. And it's meant that some employers have claimed erroneously for staff who weren't eligible. Another area is where the employer receives public or grant funding for an employee, and they cannot also claim for those employees' wages under the job retention scheme. So the main example we've come across of this is preschools and nurseries, who have needed to do some careful calculations to ensure that they are only claiming for staff whose wages are not covered by their regular government funding. However, the biggest error in making claims has been identified by HMRC in claiming employers' national insurance. Where an employer is already claiming the employment NI allowance of £4,000 per year, then under these circumstances, they cannot also claim employers' NI on furloughed staff pay, as technically there's no liability. And the final area is when making claims for the pension contributions. These can only be made at the minimum rate of qualifying earnings. And do make sure that the employee is actually in the pension scheme. Yes, erroneous claims have been made on this point. So a detailed guide is available on the gov.uk website, recently updated on the 12th of June. So do refer to that and to the examples given to avoid errors in your calculations. As things stand at the moment, where you have overclaimed, you can now declare this and make the appropriate adjustment in your next claim. If you've underclaimed, however, then you will need to contact HMRC to discuss your next steps. Now, some of you may well have chosen to top up your employees' pay to 100%, which is great. But if you haven't, there are a couple of things that you will need to keep in mind. The first is holidays. As holiday pay is contractual, it will need to be paid at 100%. So care will need to be taken around bank holidays, of which there have been several in recent months. There is guidance on this, and it does state that the policy on holiday pay will be kept under review, so it's worth checking this out if it applies to you. The second situation requiring care, if you're only paying at 80%, is if your employee is undertaking some training while they're on furlough. While they're not working at all, the national minimum wage rules don't apply. However, if they are training, then you must ensure that they are receiving the national minimum wage for all of their training hours. And a reminder that up to the end of June, your employees cannot work or volunteer while they are on furlough. So this is now, but you'll be aware that following the Chancellor's briefing on the 29th of May, things are changing. From the 1st of July, flexible furloughing is introduced, whereby your employees can return to work part-time, being paid by you at their full contractual rate for the hours worked. The furlough pay will be calculated as 80% of the hours not worked, and the working pattern can change weekly. Support from the government will also be tapered down from August, first removing employers' NI and pension contributions, and then from September decreasing the percentage that can be claimed against furlough pay, so that by October the grant will be calculated at 60% of hours not worked. Employers will need to make up the difference to 80%. And you still have the freedom to top up to 100% full pay if you choose. So please note that if you have not furloughed a worker for the first time on or before the 10th of June for a minimum of a 3-week period, then they will not be able to participate in the furlough scheme from the 1st of July. There's also a new restriction that the total number of employees that can be claimed for at any date cannot exceed the maximum number in any claim prior to the 30th of June. The claim portal is expected to change again, as you will need to include details of the hours actually worked and the hours usually worked by your employee and the hours they actually work for each of your employees. And more details on how to calculate your claim are now available. There's another deadline, so please note that all claims to the 30th of June must be made by the 31st of July, and the scheme is expected to close on the 31st of October. So in summary, do follow the government guidance and do check for updates. Keep all of your paperwork for a minimum of 5 years, including your letters to employees, written confirmation received from them, and the calculations and details of each claim that you make. Now, we are holding a lunchtime webinar next week on Tuesday the 23rd, devoted entirely to the updated furlough scheme arrangements. And our panel there will be joined by solicitors from Edward Connor. They will be discussing the furlough scheme and also what to do in the event that you don't have any work for your employees to return to. So there's going to be a Q&A session on that time as well. So if you have any questions on any of this, please do sign up at www.stewardship.org.uk/events and join us then. We're probably not going to be answering questions on the furlough scheme today, as we'd like to leave room for the other subjects, but do feel free to type them in and we'll bring them to the webinar on Tuesday. If for any reason you can't make it, do drop me an email and we will try and sort something out for you. Okay, let's move on to our next item. Alan is going to talk to us about other available financial assistance. Thank you, Alan.
Great, thanks, Jackie. Yes, just two areas I want to touch on briefly. One is the government-backed loan schemes, and the other is a deferment of any tax that's due. So let's take those government-backed loans first. There are two schemes that may be of interest to Christian charities. Now, to be eligible for either of the schemes, then the charity must be based in the UK, and you must have adversely been affected by COVID-19. Both schemes have in place turnover tests, which we're seeing banks in practice seem to be interpreting for charities as gross income. Now, the smaller scheme is called the micro loan scheme, otherwise perhaps known as the business bounce back loan. This scheme provides loans of between £2,000 and £50,000, and that goes up to a maximum of 25% of turnover. The loans are repayable over up to 6 years, and they are 100% backed by the government. There are no setup fees, there are no repayments necessary in the first 12 months, and interest for the first 12 months is covered by the government. The second larger loan is the Coronavirus Business Interruption Loan Scheme. These loans range from £50,000 up to a maximum of £5 million. They are also repayable over up to 6 years, and they will apply with entities that have a turnover of less than £45 million. Lender fees and interest are covered by the government for the first 12 months, but this time the government will guarantee only 80% of the borrowing for that. Turning now to tax, the deferral of tax payments. For PAYE, NI and corporation tax, charities that are struggling with those outstanding tax liabilities may be eligible to receive support with their tax affairs through HMRC's Time to Pay service. Now, these arrangements are agreed on a case-by-case basis, and they're tailored to individual circumstances. The current official guidance states that interest will be payable on any tax paid late as a result of agreement with HMRC, but that penalties will be avoided if contact is made in a timely manner. Turning to VAT, charities that are registered for VAT can defer their VAT payments. And again, we suggest that you keep an eye on the official guidance to see what periods are going to be covered in this. Now, there's a lot more on these schemes and other sources of financial assistance within our COVID resources pages on our website, and we would suggest that you keep a close eye on those because they are changing from time to time.
Great, thank you, Alan. That's really helpful. Another issue which has been highlighted by COVID-19 is making decisions as trustees, and we've got a little section on this which is brought to you by Stephen.
Thank you, Jackie. Yes, being a church or charity trustee right now is not easy. All the normal rules of operation appear to be removed, and even the simple task of meeting together is not possible. So how do you make good biblically based decisions at a time like this? Well, one of our partner firms, Edward Connor Solicitors, have produced a short paper for Christian charities, which is on our website. And here are 3 key points. 1, seek wisdom with humility. There is an incredible amount of information out there, and it isn't a fault to admit we don't have all the answers. So we acknowledge our need and seek God's wisdom with humility. It's not about just having information. This is about wisdom. As the Apostle James says, if any of you lacks wisdom, he should ask God. And a big part of a trustee and a treasurer all the time, but particularly now, is actually in praying, in my mind. 2nd, lead with integrity. This is about communication, firstly. Communication in the team, in the church, or with your supporters. And document well. It's really important to be clear in the decisions you are making. Thirdly, be aware of the legal framework you're operating under. What money you can use for what purpose. Alan's already talked about restricted funds. And secondly, the limits on what your governing document allows. Thirdly, make decisions sacrificially. More information is needed right now. More time is needed for sure, because you're looking at things so much more frequently. And possibly most importantly, there are likely to be difficult decisions ahead. Don't put them off. Prevarication hurts others. Great churches and charities need great trustees. And now is a time to be a great trustee. Back to you, Jackie.
Thank you, Stephen. Now, just before we end our COVID-19 section, Stephen and Alan are just going to share what they have done to address the practical issues caused by the pandemic in their churches. So, Stephen, can I come back to you?
Yeah, please do. Now, my church operates in southeast London from rented venues, has income of around £350,000, mostly given online, and has 6 staff. So what do? We went online Sunday meetings with YouTube and Zoom meetings for prayer and social events. We communicated that we had a COVID community fund to help those in the local community or in the church who were suffering real need. And we've given away about £2,000 so far, slightly less than expected, but we expect much more in the future. We applied for £5,000 for this community fund from a public London funds grant, but were unsuccessful. But actually the generosity of members of the church has fully replaced that. We've started talking about special offerings and a sense of partnership in the fresh opportunities this season is giving us as a church, but also about the widow's mite principle. We don't want just large gifts, but every person doing their bit. And what we have found is unexpected generosity from unexpected quarters. We've reforecast the finances for this year to August 2020 and into whole of next year, 2021, and monitored closely April and May to see whether they were above or below expectations. They were in fact above. We've looked at how much reserves were going to drop by over that period and what level of reserves we considered we shouldn't go below. We furloughed one of the pastoral staff and paid 80% of full salary, having checked this wasn't going to be a massive problem to them. And we moved our accounting system to an online version and thought about financial controls in the light of different people not being able to do the things they did. Thank you.
Yeah, just picking up from that, from Stephen. Again, my church is slightly different. We're based in Essex, but we're not a dissimilar situation. And I guess so, not surprisingly, we've taken similar actions. So we too have moved to an online setup. We now meet as trustees every fortnight and have set up a COBRA team, which is selected trustees and church leaders to discuss all things COVID. And we're monitoring our standing orders and online giving on a weekly basis. And so far that's been so good. We too have set aside an initial £5,000 as a designated COVID relief fund. As yet this remains unused, but as Stephen said, we're expecting calls on that to come in the future. We've prioritised our staff costs and our mission partner giving. So we've chosen not to furlough any staff at the moment, and we're treating those as our highest priority in terms of our expenditure. We've established a rolling 6-month cash flow, which we look at every month as trustees. And we've increased the number of people who are able to access bank accounts and to make and authorise online payments, just to make sure that we don't fall short. So very similar actions to Stephen in his church.
Great, thank you both. That's really helpful. Let's now move to our final item, which is our mosquito effect on gift aid, the common errors in claims. And Alan is going to come back with that one. Thank you, Alan.
Great, thanks. Yes. So just while COVID-19, it does not appear at the moment to have slowed the repayment of gift aid claims. We're hearing that charities are being able to put claims in and recover them fairly quickly. But what HMRC have done, they've identified some common errors made on claims that do actually cause processing delays. So what do we need to watch out for? The main one they identified actually was the data about the person who is known as the authorised official who's submitting the claim. Now, if the person is unknown to HMRC or has changed their name, maybe by marriage or for some other reason, and has not informed HMRC of the change, then that will hold the claim up. Similarly, if the person has moved and has not updated an address, or the correspondence address has not been updated following a change of the authorised official, that will do the same. And thirdly, if HMRC has not been notified of a new agent or nominee. Now, where changes to authorised officials have been made, which now normally comes through the government gateway on the form CHV1, confirmation letters will be sent out by HMRC, and you should check those to make sure that the details provided have been correctly recorded. A couple of other reasons as why claims are being held up. So sometimes we're claiming for donations that are out of date. Now remember that different rules apply to Gift Aid Small Donation Scheme as opposed to Gift Aid. The Gift Aid Small Donation Scheme time limit is only 2 years to each 5th of April each year, as opposed to 4 years for Gift Aid. Now we recommend making both claims at least annually, and if not more frequently, especially at this time to aid cash flow. Another reason for delay was entering a claim for Gift Aid Small Donation Scheme, which is larger than the maximum £8,000 property limit. Now, it was not felt that charities were trying to defraud HMRC, but by entering actual cash donations that exceed that limit will cause delays. And finally, claiming gift aid on limited company donations, which is not allowed. So in times of uncertainty, we want to do all we can to make sure that the claims are not being needlessly held up. So just have a look through your claims and make sure you're not falling into any of those traps. Thank you, Jackie.
Great, thank you, Alan.